the next session, it's about fintech partnership, open banking, and data sharing. And so Cross River Bank CEO will be speaking about that. And so just a little bit of introduction. Cross River Bank is a state charter bank under the FDIC. It's a community bank, but it's a unique community bank in that it has a lot of partnership with both fintech firms and traditional banks. So I think that's the reason why we want to hear from Gilles Gade about what's going on, what they are doing, and the moderator for this session is Gerron Levi. She's the new head of government affairs at the American Fintech Council, which is a combination of the old Marketplace Lending Association and the old Online Lending Policy Institute, right? Okay, so go ahead. Thank you so much for being here. Looking forward to the discussion.
Well, it's a pleasure to be with you this afternoon. I think we have a really good conversation on some of the policy considerations around these issues coming up. And so, Gilles, why don't we start by you telling us a little bit about yourself at Cross River?
Sure. So pleasure to be here with you. And thank you for having Cross River Bank prominently displayed on this in front of this August audience. And I truly hope and pray that we'll be able to provide some insight into the realms of fintech and particularly marketplace lending and other areas. So I came to this country from France about 30 years ago. I worked on Wall Street for a little bit, about 12 years, and learned a lot. And in the process of learning, I delved in financial services, particularly in the FIG group at Bear Stearns, financial institution group. And one thing led to another, and this opportunity of founding a bank came to me about 14 years ago in September of 2017. And it's been a tremendous adventure ever since. We're very proud members of the New Jersey Banking Department. And so we're basically a state chartered bank in New Jersey. And for the past 14 years, we have been very fortunate to cater and service the fintech ecosystem in a way that has been fairly significant. Now, fast forward, we have roughly about 650 employees on 2 continents. We have about 500 here in the US, mostly in New Jersey. And we have about 125 people in Israel, and that's our development team. So we have software development in Israel.
Thank you, Gilles. Let's get into the buy now, pay later space. This ecosystem, it continues to grab headlines, shows signs of massive growth and disruption. Can you discuss how Cross River views the developing landscape and really the evolution of marketplace lending as a whole?
Right. So that's actually a fascinating development that occurred post banking debacle, Great Recession, 2008. Most banks exited the HELOC program, the home equity line of credit, which caused havoc in people's finances because they were counting on some of the equity in their houses in order to afford the extra things that occurs in life that sometimes are just necessary expenses, like paying off a tuition or buying a wedding ring or paying for a wedding, for that matter. So folks just became very dire straits in a way that they could not afford life anymore. And in comes, a very newly found way of financing their lives, and that's marketplace lending. And the folks that wanted to step in lieu of the large banks, called the marketplace lenders at the time, they started with Prosper. I think that's a precursor of the entire market, then Lending Club, then Firm, Upstart, Upgrade, Marlet, Rocket Loans, and many others that followed suit. And today you could count, I don't know, maybe 40, 50 players in the marketplace. About 16 or 17 of them are clients of ours. And what they did do, though, is to solve 2 issues. Number one, the lack of credit altogether, but also while they were at it, they said maybe we can reinvent the way that credit is being approached and broaden the credit spectrum so that people who did not have access to credit to begin with, whether it be through a HELOC because they own a house, or folks that have been shut down by the credit card process, for example, folks that did not have accessibility to credit. So they reinvented underwriting and broadened the credit spectrum so that more folks would be able to afford life, provided that they could actually afford that credit. And that's how BNPL came to life, which answers a very big question, is the fact that if you are purchasing an item online, for example, right, and you don't have access to credit, how are you going to afford that? But if only, so it is true, you may not have access to a credit card to the amount that you wanted to get access to a card, for example, let's say $10,000 or $15,000. But if you wanted to buy a TV at Walmart or a Peloton bike on the Peloton website, being able to afford that credit, paying over 12 months or 24 months is a phenomenal thing that was not available before. So that has really opened up the floodgates of credit wide in order for people to actually afford the things that they were dreaming about in a newfound way.
Great, thank you for that. Really, what are the roles of banks, chartered financial institutions in promoting this, evolution in the market? I mean, are these fintech competitors? Are they partners, or really both?
So I think the banks really play a pivotal role in different dimensions. Number one, we do play a role of guardrails or of oversight and regulatory compliance. And that means that we're the last bastion protecting the consumers. Our responsibility is to ensure that the consumers have not only access to credit in a fair and unique way, but also that when they do access that credit, that they're not being hurt or harmed. And that includes, unfair and deceptive practices, fair lending, and so on and so forth. So we have to ensure that all the regulatory compliance that does apply to consumer loan are being actually executed and are being protected. So that's one of the roles that the banks play, which is, I think, pivotal and critical. Number two, we do play a role of funding, and that means that those loans sometimes the market dries up for whatever reason. It could be macroeconomic. In 2015, there was one company that was playing a game of capital markets that was not appreciated by the market. And then ultimately, all the securitization players, they exited the market. That means that the entire velocity of those loans dried up. Those loans did not find purchasers. Now, that in those kind of cases, that's when the banks actually could come in and play a role of being America's balance sheet, and which is, I think, what the banks were designed to do to begin with. Number three, the banks could play a role of partnership with those fintechs. And that partnership basically entails that there is a consumer protection, number one, like we mentioned, number two, financing, but also capital markets activity and ensuring that there is constant funding for those loans. And particularly when you have a community bank in their footprints that cannot cater to a particular consumer base because they're not equipped, because they don't have the right products, the right services, because they're not big enough, whatever the case may be, partnering with a fintech partner basically engenders a newfound volume for those banks that did not exist before because, they did not have the ability to originate those loans. So now if they partner, they could suddenly originate those loans, provide accessibility to credit to their clientele, and then whether they want to keep those loans on balance sheet or not, that depends on their risk appetite. But there's so much flexibility on how they could play that game and how they could enter the game of, I don't want to call it a game. It's actually very serious. But the ability to provide access to credit to folks that until then, the community bank was probably serving, I would say, 75%, 80% of the market, but certainly not 100%. This provides full access to credit to the folks in their footprint.
I guess you speak a little bit further about the benefits you have seen come from, for example, some of the buy now, pay later alternatives. How do you see the impacts for consumers and the industry alike? You've spoken a little bit to that, but there are a number of alternatives to buy now, pay later that are entering the market. So can you speak to that a bit?
Sure, with pleasure. So one interesting fact about BNPL is that everybody is becoming a fintech company. You could be a deep manufacturing company with 100 years of history, and suddenly you turn into a fintech player because you have accessibility to a front-end technology that will enable people to purchase your goods and services online. And now let's say that the people can afford to pay upfront for the full amount. So you have a certain percentage that could pay upfront. You have a certain percentage that could pay, via credit card over time. And now you have a new market that opened up for folks to be able to pay over time, over 12 or 24 or 36 months, depending on their credit worthiness. So that basically keeps enhancing the spectrum of the availability to credit. So that is a huge game changer for folks, not only for the merchants, but also for the consumers. So first of all, the consumers, like we said before, they didn't afford credit before. Now they have accessibility to credit. Number two, for the merchants, that really triggered a huge influx of demand for their products and services. So in turn, what they do is that instead of charging interest for that credit, that credit is becoming free because it is subsidized by some of the merchants. So you are entering really in a very creative way to finance the operations of an enterprise. So that means that a certain enterprise that was in manufacturing, let's say a very old-fashioned manufacturing company that now sells products and services online to folks that they never sold those services to. Now, those people now have access. In turn, that means there is growth in the economy. And then there's also the ability for the people that couldn't afford credit before to get access to credit in a way that is actually free for them as well. That means it's an interest-free loan or a loan that is severely or extremely subsidized so that they could actually afford the goods and services. So basically it makes everybody happy. Right? It makes the consumers happy because they have access to that credit. And number two, it makes the merchants happy because they have more goods. And then in turn, they share that upside with the consumers who are buying goods. It is really a phenomenal model that has absolutely helped the economy, particularly during the pandemic. Without BNPL, I'm not sure the economy would fare as well today.
So I think you're, making a case that, these offerings are using modern technology to really expand access. And this was touched on a bit yesterday, but are there growing use cases for incorporating, alternative data, AI, machine learning, and automation more generally for both consumer and small business lending?
Absolutely. I'm a strong believer of that. There is a way to keep the guardrails up in order to not fall prey to fair lending violations. And this is something that we really need to keep a very close eye on. That said, there's no question in my mind that AI has definitely enhanced the ability for folks who did not have access to credit to finally gain access to credit. Just to give you an example, FICO was determinant in providing access to credit to folks, right? So in other words, if you did not have a FICO score, you could not get a credit card from any bank in America. And that's not a long time ago. That's even 5 years ago. So now what that does is that there are other ways to verify the credit worthiness of an individual. That individual, let's say, is coming from overseas, from abroad, they're a new immigrant. What is the reason why we can't provide them access, even though they probably have a good job, they could afford life on a day-to-day basis? There are other ways of verification whether they could afford credit. So that's where AI comes into play. And what AI does is that it actually benchmarks similar people who have, similar experiences in order for them to experience the same accessibility to credit. That's what AI does. So that means that the system keeps teaching itself on who to verify and who to accept as a creditor, as a borrower, and who to reject. Now, on the rejection side, so because of that, a lot more people have the ability to buy goods online because of the lesser reliance on credit scores, on FICO, and other traditional metrics. What that goes invariably, it has to go hand in hand with a far more robust fair lending exercise to make sure that folks are not being discriminated against. So that's basically the crux of the matter here. So it's really a progression on both ends. There's definitely a progression in accessibility to credit, but also the fair lending exercise keeps also being enhanced because you want to avoid any pitfalls.
Well, sounds good. Let's turn to the payment ecosystem, which is also rapidly evolving and helping to provide more efficient solutions. What are some of the newer payment capabilities in the industry that you can speak to, and maybe speak to some of the barriers and opportunities we might expect moving forward?
So the U.S. Particularly is set up as such that you need to be a bank to belong to the back-end system. So in other words, the payment rails, whether it be the Federal Reserve, so the ACH network, and a host of other services. So you ultimately will have to go through a bank in order to execute your transaction as a settlement mechanism. You need two banks to settle a transaction. You need a receiving bank and a sending bank. So that's the way that the American system has been built, and I don't think it's going to change anytime soon. And that's good for us, right? And it's good for the people who are listening here on this chat. The primary products that have been really faring pretty well over the past 2 to 3 years have been the advent of RTP, for example, right, or same-day ACH, which has met with a tremendous amount of success. I would say crypto now, and I know that is something that is probably burning on everybody's lips to ask about crypto and what do we think about it. So we could touch upon that a little bit later if you want to. Crypto is definitely a payment rail that is going to have to be reckoned with. There's no question about it. And just to see the sheer volume of crypto exchanges and the market capitalization of all cryptos altogether combined is just something that we have to come to grips with what a crypto is and how we're going to best utilize it to facilitate exchanges and particularly to be something that the consumers deserve to have access to.
And the barriers and opportunities there.
Right. So the barriers to entry, like I said, you need to be a bank. That's number one. Number two, there is invariably there are scalability issues. So now comes into play the technology aspect, right? The core processing engine that sits on top of those rails. Are those engines capable of following the velocity of those transactions? Because now you want to do an automated wire, for example, right? You need to be able to compose with a Coinbase, which has, demands of 2,000 to 3,000 wires an hour. So, on any given day, they could do 20,000 wires. So if you had a wire room and you did things manually, you would have to hire a lot of people to be able to execute those operations, right? So that's where technology comes into play. But the backend system, is it capable of withholding so many transactions to verify the KYC, the BSA, the AML components, right? The velocities and the triggers. So that's where technology comes into play. That's another barrier to entry. So on the one hand, you have naturally the necessity to be a bank. On the other hand, you have technology on the back end side, the connectors basically to both the front end of the clients, the fintech clients that are exercising those transactions, and then the connectors to the back end, to the folks that are providing a core processing engine. So these are, I would say, the major barriers to entry. And naturally, the third one, which is not the least, is from a regulatory compliance side. Do we satisfy or do we check all the boxes? Do we satisfy the risk management tools? Because you're dealing with very high risk agents, right? And are you treating them as such? Money service businesses, foreign remitters, third-party payment processors. All these are buzzwords to some, but they're real red flags to the regulators. And we need to compose with that, and we need to make sure and ensure that there's integrity in the entire system.
Yeah, I mean, you brought up the regulatory barriers, so I think it's probably a good time to speak to some of the newer innovations on the horizon that both the industry and regulators should be keeping an eye on. I mean, what do you imagine the financial services landscape to really look like in the next 5 years?
That's a great question, and it's it's a little bit of having a crystal ball in my hands, and
Well, first speak to what you think what the regulators and the industry need to be looking out for.
Right. So so in our humble opinion, it is absolutely necessary to review and revise some of the examination manuals to cater to a modern way of doing banking. There are certain rules and regulations that do not apply to the common folks today. And this is something that we collectively need to sit down at the same table and have an honest and candid discussion, because applying all regimes of examination manuals on regulations that are obsolete today is very difficult to compose with, and it's not even fair on the examiners. So I would say the urgency is really to take a second look at the exam manual and collectively try to come up with the right questions to ask when we're operating in a totally different sphere, whereby most of the transactions are electronic, and particularly when the consumers expect to begin with to be the behavior, right? Behaviors have changed over the past 5 years, let alone over the past 10 years. So this is definitely something that we need collectively to take a look at. And I believe that Chairman McWilliams has been taking the lead on that with her fintech office, as well as the OCC to some extent on certain things such as crypto. So we welcome those debates. I think it's necessary for the community bank environment also to be part of that debate so that we can actually participate, because as we all know, community banks have been subjected to the stringencies of the regulatory environment are the same standards that the big banks in certain ways. And that also has to be reviewed, depending on the size of the institution, because at the end of the day, you may have a small institution that does a lot of volume of those transactions with scalability available today, right, with technology. So that's another aspect of the regulatory environment that we need to take a look at. And
well,
then go ahead, please. No, please.
No, because I asked you what you expect the landscape to look like in the next 5 years. And, you've mentioned crypto a couple times. And so I wanted to, give you an opportunity to speak to, how you see the landscape and also if you see crypto as having a place in the future of banking. Maybe you can kind of address those two together a bit.
So I am personally a big proponent of the banking system. I believe that the banks play a critical role that I explained before. There's 200 years of regulatory compliance DNA that basically should help the consumers to be protected. That's our role. And we need to ensure that. And the better equipped we are with new technology, with the advent of the ecosystem, being in the fintech world, we need to embrace that responsibility. And crypto falls in squarely into that category as well. I truly believe that the crypto universe needs to reside within the bank. That means that banks need to custody crypto. We need to create bank accounts that could actually house both fiat currencies and cryptocurrencies. I believe that we need to be able to lend against crypto. And that's a new asset class that needs to be reckoned with. And then finally, and we need a lot of definitions there, such as, is cryptocurrency a currency, or is it an asset, or is it a commodity? So all these things need to be determined, once and for all, so that we have proper guidance to be able to conduct that business. the more we wait on those definitions, the less the banks are going to be likely to participate in that universe. And that's dangerous because we think that bad actors could snip in. And unfortunately, that's not going to be controlled within the banking environment, which I know that the Federal Reserve is a big proponent of. And then finally, a big item of cryptocurrency is the ability to issue stable coins. And these are the quintessential mechanism to transfer money from point A to point B seamlessly. That means from a financial inclusion standpoint, if you truly believe that financial inclusion should guide our ways of banking of tomorrow, if you want a crystal ball here, this is it. Mm-hmm. Is I believe that there are way too many people who do not have access to our banking environment because of the stringencies that are being imposed both on the fintechs and on the banks. So the sooner we get at the table and we discuss all these issues, the sooner folks in the four corners of the world will have a better access to their financial networks that will definitely enhance wealth and happiness across the entire world.
Okay. I mean, you spoke a bit to how some banks are embracing, the technology in a safe and sound and responsible manner. It sounds like you're saying to, banks playing a custodial role and otherwise. Is there anything more you could say about how to manage these new technologies safely and responsibly? I mean, is there anything more you could add to that?
So the way we have been doing it is we white paper everything. And that white paper serves two purposes. It helps us understand what we're about to get into, and it helps also provide comfort to the regulators that we know what we're getting into. Right. So there's a dual purpose here. So the way we write our white papers are very, very much towards the regulatory compliance environment. And once we have that risk appetite determined and the regulatory component down pat, then we enter into the business side of the new technologies, particularly whether it be on the crypto side or the payment side, or even on the marketplace lending side. So we white paper things, then we enter into a discussion with our regulators, particularly with the FDIC. We also participate at roundtables with the other agencies, such as the OCC, the CFPB, and the Federal Reserve. So once we have enough elements, and we find comfort to enter into a new business, then we prepare ourselves from an operational standpoint. Operations is the key connector to regulatory compliance, not the business side. The business side comes much later down the road. Once we have all these down pat, then we can actually start selling. So we create a business unit, we hire the right folks that truly understand the business, and then we start selling. Anything, and some banks may find a permutation of this better for themselves because they do have an expertise already from the get-go on the operational side or on the regulatory compliance side. But this is the way we feel comfortable about entering into an endeavor such as this. So we did cryptocurrency for the past, we've been doing cryptocurrency for the past 7 years now. Coinbase has been a client of ours. We treated them at the highest standard of regulatory compliance as an MSB, money service business, even though they didn't really technically fall into that category at the beginning of the advent of cryptocurrencies. But because we adopted such stringencies, then it made our regulators more comfortable that we experienced a tremendous explosion of cryptocurrency transactions, and we have been the beneficiaries of such, but always within the confine of a regulatory compliance environment that is extremely narrow. So that has been our motto for the past 7 or 8 years or so. And I'd be more than happy, by the way, to engage with any of your listeners privately to share our thoughts and to share some of our white papers or whatever we know of this market. We're here to help because we're big proponents of this industry, and we believe that this is the future of the banking industry as a whole.
So how do you see future offerings around crypto, really evolving? Will banks be able to meet the needs and to support the needs of both consumers and businesses? How do you see, it evolving a bit? The offerings around crypto.
So I think number one, we have to treat crypto as a new payment rail, same as some of the networks or the Federal Reserve, ACH, or an IBAN or a SWIFT. So this is just a new way of transferring money that will help businesses, because some businesses have a tendency to be a little bit more with a proclination that is with a tendency that is more towards modern technologies than others. You have some younger people that have a very strong appetite for new technologies. So these entrepreneurs who are going to start opening businesses or have consumer accounts of their own, they expect for the banks to be the repository of all their assets, and that includes cryptocurrencies. And because the banks have that 200-year-old DNA of regulatory compliance and protection of the consumers, we will make sure to put the proper guardrails so that those assets are protected from a cybersecurity standpoint and also from an identity theft standpoint. So these are, I would say, some of the elements that will help our industry tremendously. Is the rapid adoption of cryptocurrency or any new payment rail that comes down the pike. And we're going to need to press our core processors to embrace those new assets or those new technologies much faster than traditionally. As we know, it takes a while for them to adopt those technologies, which takes a while to trickle down to the banks. So we have to accelerate that cycle tremendously. That will trigger the sustainability of the overall banking system.
Great. Thank you for that, Gilles. Maybe we can, as we get towards the end here, speak to how the industry can work with policymakers to create a regulatory framework that, not only supports, but encourages innovation. Do you have some thoughts on that?
Sure. I think what the agencies have done over the past few years has helped tremendously, inviting the banks to, or stakeholders for that matter, to participate in RFIs, in requests for informations, and that will ultimately drive policy. So this is a this is a step in the right direction. We're only in the first inning of that evolution. The only comment I have is that I think this is, like I mentioned, a step in the right direction, but we need to take the second step much quicker. The analysis of those RFIs, the sharing of those RFIs, the conclusions that our regulators are driving from those RFIs are necessarily to share in an expeditious manner so that we can start gearing up for the next phase, for phase 2, phase 3, all the way down to the 9th inning. So I wish we could accelerate the process, but as we know, the regulatory environment and the legislative environment is very slow to begin with. So maybe we could create a caucus of banks representing the banking system, of stakeholders representing the overall ecosystem, so that we could maybe accelerate the dialogue a little bit. So that's definitely one request that I am publicly making on behalf of our policy affairs group, because I know, this is a key element for our growth and for the growth of the overall industry. The second thing I would have to say is that the AGs now are starting to really, truly understand what's best for their own consumers. And they have a little bit of a different approach than the federal regulators. And the state AGs could definitely play a big role in advancing the interest of, and we know of some very progressive AGs such as Colorado, Wisconsin, even California to some extent. So we're truly blessed to have folks that are blazing the trail in order to bring that at the forefront of the communication between the banks and the consumers which are essential to advance the interests of the consumers ultimately, because that's what we're here for. So the more consumer demands drive those conversations. So in other words, you have a grassroots effort that is done at the consumer level all the way up to the AGs. And then you have all the way on the top, you have the federal regulators who are trickling down those same conversation. And hopefully at some point they'll meet in the middle. But hopefully when they meet, that's very soon and not, in a few years down the road.
I was getting ready to say that's very hopeful of you, Gilles. I guess in our remaining maybe minute or minute here, maybe you could just speak a little bit about how Cross River, in this policy discussion really balances or strives to balance, consumer protection with, all of these technological innovations and modern solutions. I mean, some people see those two things as, innovation and consumer protection and contradiction, but can they supplement each other? Can they live side by side?
Absolutely. I don't think they contradict each other at all. On the contrary, I think that one engenders the other. So in other words, in order to originate 15 million, 20 million loans annually, which I think we're going towards, astronomical amounts of loans that are being originated on an annual basis, because now you can make a loan on a $200 purchase. Right? So micro lending came into play, which triggers the necessity to verify the adequacy, the compliance adequacy of that loan. So that means that we need to use technology for that. You're not going to be able to hire enough people to verify 20 million loans. It's just not physically possible. So technology has to play a role in this. That means innovation. So in order to engender more innovation on the front end so that more people can afford life on a day-to-day basis, we need to engender innovation on the back end so that we can continue to scale the model. So that goes hand in hand with the regulators. When we have to be a listening ear to our regulators, we need to make them feel comfortable by the processes. And I'm not talking necessarily as Cross River, I mean like collectively. And we need to sit at the table collectively and to try to come up with solutions that are innovative themselves. Innovation is not necessarily on technology. It's also on thoughts. It's on the regulatory side. It's on capital markets. It's on operational efficiencies. It's across the board. So people have a tendency to focus only on technology. Let's leave technology aside also for a minute, right? The core of the process, like for example, when you're executing a loan, when you're originating a loan that is online, how dependent are you on technology on the one hand, but also how dependent are you on operational efficiencies on the regulatory compliance and finance? So all this needs to be reinvented, and in order to cater for that exponential growth. So that is something that is very front and center for us particularly. And again, we welcome the opportunity to speak with you and to speak with at this conference, and hopefully we brought some elements of discussion, not necessarily answers. The answers are further down the road, but hopefully we will be able to trigger some discussion, and we welcome the dialogue, and thank you again for the platform.
Thank you, Gilles, and Jalapa will be the ultimate decider of that. Did we bring solutions or just discussion? But thank you so much for that, and I'll turn it back to you.
Thank you very much, Gilles and Gerron. Really appreciate taking the time to talk to us. The video will be made available after the conference.